Okay, so this is going to be training for how to use Nadex, and also for how to do use it with your charts. And I have one of my clients, Ghislaine, with me, and so we're going to kind of go over all this. Okay, so Ghislaine, what did you want? First off, did you have any questions?
Yes, I would like to learn more on how to have my trading plan, know a little bit about the price action, and how to take a trade on Nadex based on chart analysis.
Okay. So let's do this. We'll go over the per our talk the other day. We'll start off with the indices, or the binary side of it. Then we'll go into the call spreads and then the touch brackets, and kind of go over and try and create somewhat of a trade plan, but also something along the lines of how they work, the inner workings, and which are the best that I believe, because everybody trades differently, but the best of what I believe will work based off of my type of a risk management. Okay, so right now, if you just come over here, click on indices, US 500, and these are different ones we're going to do. For right now, we're going to just do the dailies that expire at 4:15 Eastern time, okay? And right here we have all of the active binaries that are actually active. Indicative price is actually the same exact price you could see over here for the E-mini S&Ps. And then we're just going to use a 5-minute chart for the ESs, and we have our overnight high and low with Fibonacci's, and then the yellow lines are going to be the first hour high and low, and then the little red lines are the 38 and 61% Fibonacci's. Okay. So with that being said, news just came out, and I saw earlier, I believe this is manufacturing news or something, or productivity or something, came out the worst in like a decade, they said, and that's why we're seeing this collapse right now. And that's a kind of, it was a news-driven event. With that being said, we already we blew right through the 127, the 161, and the 200% Fibonacci extensions from the overnight high and low. The first hour we're still making. So let's just say, for demonstration, let's say we wanted to get long around these levels. Okay. What I'm going to do is I'm going to look, okay, hey, we're currently at 29.69. Well, if I come over here, we have 27.73 or 29.67. Okay, so what I'm going to do is I'm going to pull both of these up real quick. So that's 73s and then the 67s. And one of the things with Nadex, especially with these binaries, is since we're going out till the 4:15 Eastern close, what's happening right now is we still have about 6.5 hours, or about 6 hours left in these contracts. So you're going to have some premium in them, okay? But if we look, so if we look right here at the 2967, we're at 49 by 53. Well, the ESs are 2965 and a quarter. Okay, or 2965. So we're not even at 50. So that's kind of where the premium lies, because if we're at 2967, this number, the bid offer should be around 48 to 52, give or take $1 or $2 based off of the implied volatility. Or sorry, based off it being at the money. Does that make sense?
Yes.
Okay, but because it's 49 and by 53 and we're at 2965, it's also a news-driven event, so they're just kind of readjusting the prices. But you see, there's one person who's trying to get out right now at 49, more than likely. And that's why 49's not moving, even though this is moving up $1 or $2. But if you look right here at the bid size, 200, okay, whenever you see the 200, that's usually just the market makers showing orders. And same with the 75. But so that 3 just either canceled or got filled, okay, on their order. And like with regular options, a lot of times what happens is with the options, you could get filled in between, or like you could adjust prices, go in between the spread. With Nadex, it really doesn't work that way. It's either all or nothing. And here we go, we see that 3 guy, so it looked like he canceled, and now he's back in. But until the offer comes down to 49, he won't get filled. Does that make sense?
Yes.
Okay, it's not like unless somebody comes in and buys his 3, okay, that he's trying to sell, sell is somebody goes short at 49, he's not going to get filled. So there's really not a ton of liquidity in the binaries. Okay, so like right here, the 200 or the 75, whenever you see those numbers, those are usually just the market makers. Okay, they're not going to be individual guys. So that guy just got filled because the offer hit 49 and he got filled.
Okay.
Does that kind of make sense?
Yes, I see that.
Okay. So it's one of those things where you either you actually have to go up to the price, or literally wait for the market to rise or fall until you get hit. So right now, let's just say we're bullish at this level down here. We think this is a support level around the 64 level, and we want to get long the binaries. Okay. Well, we can either look at the 2967 or we could look at the 73. We see if we get long at 67, and currently we're at 65, we're going to have to pay, we'll say $53, or let's bring it down to 52 even. Okay? Over here, if we want to get long the 73s, and we'll just round this off to 37, this is our max loss is $37 what we pay. Our max profit would be 63. And on the 267, our max loss would be 52 with a max profit of 48. And the max profit would come essentially if we close above, since we're long, looking for long, if we close above 2967 at 415, we would make full max profit and the contract would expire and it would go to cash. So we'd get back our 52 plus our 48. Okay. And same thing here. Now, why would we do the 67 versus the 73 or vice versa? Well, this contract will only cost us $37, so we have less risk and more profit. Okay, but our break even won't be until 73, which would be where this white line is right here on the chart. Okay, now if we rally all the way up to this white line, then what do you think the bid offer should be on this contract?
It will go higher.
Correct, it would go higher, and because we'd be essentially at the money, meaning when this contract's at $29.73 and the strike price on this contract is $29.73, okay, how much do you think this should go for? The bid offer.
The bid offer?
Correct.
Probably 55.
So, well, look at this right here. We're at $29.66.50, right?
Yes.
And right now we're about 49 to 54 with the spread. Okay, so now remember, we still have 6 hours. Now, if we move time forward about 2 hours, we would be about 48 by 52. 48 on the bid by 52 on the offer. Those are my default numbers. And like I said, that's with less time than the 6 hours that we have until this contract expires. But if we're like 3-4 hours or less, usually we'll be about 48 by 52 when we're at the money. So like, see, we're at 29.67 and it's showing 51.50 by 56 right now. So if we bought it for 52, even though we've gone up a couple points from where we would have bought it, we could sell it at 51.25 or 53 now, and we'd be able to make $1.
Oh yeah, yes.
Okay, so now we're starting to rise, right?
Yes.
So hopefully over the next few minutes we might get a nice bounce up to the 73, because if we get to this 73, which would be about a 5-point bounce, and we put this order on when we were, or we start to look at this, right around the 65 level, right?
Yes.
So we've risen. Well, what we paid 37 on the offer for, we would now look at the bid to exit, and we would be able to sell it for $41.50 right now.
Oh, so it's like $4.
Correct. So remember, if we buy it here, okay, when we sell, we want to look at the bid. So let's look at this. When we were at that 65, 66 level, what we paid 37 for, we can now sell for around 44, which is how much? $7, right?
Yeah, per contract.
Per contract. But look at, if we would have bought that at the money, what we paid $52 for is now worth 64, give or take. Okay, so we would have made $12 here. So by putting on more risk, meaning we could have had a bigger loss, we actually gain more money. So like, But remember, it all depends on the bid ask. I'm sorry, I take that back, because we were at 52, now we're at 60, right? That's an $8 move, while here we're at a $6 move. 37 to 43 would be about a $6 move. So it's not a huge difference, but it's one of those things where if you think we're going to have a bigger bounce, okay, I would maybe go out of the money, because it gives you more time to not necessarily more time, but you're not risking as much. Or like with this trade versus this, we only made $2, right? More than over here. But our loss potential, if we were wrong and it just kept going lower, would have been a big difference of 37 to 52. Which would be a $15 loss difference. Okay, so this is why for me, and look at this, we're now at 70, almost 71. And remember, I said if we get at the money, so if we're around 73, this should be now trading for about 48 to 52. But because there's so much time left in the contract, we'll probably, there's premium built into it, so we'll probably be at like 50, 51 to 54 when we hit 73, if we do. So this is the way I personally like to trade this. Okay, I like to maybe go out of the money where I'm risking less. Okay, but also my loss is a lot less too. 37 versus 52. If you look here, we're only up $11, while here we're now up $10.
Yeah. And we're only gonna lose 37.
Correct, if it just kept going lower. And the other thing is, let's say when we entered, it bounced a little bit, but then it just rolled back over and it kept going lower and lower. Well, there's really no need necessarily to have to take a loss, because the loss is built in. If you're okay saying, hey, I'm okay with a $37 loss when we enter down here, and if price just, let's say it bounced a little bit like this, if you look on the chart, and then we kept going lower, okay, well, maybe in 2 hours we might find a bottom and have a massive rally all the way back up. Well, if we took out that low, you might take a $15 loss because of the spread of the bid ask, right? Remember, when you buy here, so you're kind of losing a big chunk. Well, it's just to let the thing go, and hopefully later on during the day it goes higher.
Yeah, because you had 6 hours.
Correct. To be correct, think of it as a football game, right? If you bet on the Denver Broncos to win the game, and the first after 10 minutes in the first quarter they're down 14-0, right? Well, they still have 3 quarters in 5 minutes left to come back, and by the end of the game, the Broncos might win 37 to 27. Okay, so you already know how much you're going to lose, but don't worry so much.
And I see we are getting closer to 29.73.
Correct. So right now when we were 2972, we were 51 by 56, I believe it said. And see right here under bid size, the reason it's so tight, the bid ask, is because somebody's bidding too. Okay, that's like if he disappeared, then that 47 would move up. And then it'd be 47 by 52. So, is this starting to make a little more sense?
Yes, yes.
So, now let's look at it for the sell side. Let's say we're right here and you're now looking to short. Okay, you're like, hey, I actually think we already bounced and we're going to roll over and go lower now. Okay, we're going to keep the 67, but now let's bring up maybe the 55. And what we're going to do is over on the left here, we have the 67, right? And we're currently at 70, and we have the 55. Well, to short Nadex, all you need to do is click on the bid in the cell, okay? And it'll load it down here. And so we'll go 95 there, and we'll go 62 here. Well, 95 or 2955 is about 15 points away. Okay? Think of these as odds too, if that helps you. Okay? The odds of us reaching 2955 right now are about 15%. Okay, so there's an 85% chance we don't hit 2955, but there's a 15% chance that we do hit 2955. With that, look at your loss versus your profit.
15 to 85.
Correct. So let's think about it this way. Okay, if I think we're going to go to 2955, okay, even though we're up here, I'm willing to risk $15 for that trade because I still have until 4:15 to be correct. Here's where the really cool part, and this is kind of where I think the nugget comes with a Nadex, where, okay, I could put a $15 bet on, but if we do roll over and price does come to this level right here, okay, this 2955, how much is this bid ask going to be?
It's 52.
About 48 to 52. So if I sell this for 85, I would have to buy it back for about $52, give or take, right?
Yes.
And let's say maybe it goes 54 and I could get filled at 50. Well, I just made $35. Right? So if I sold it for 85 and I bought it back for 50, that would be a $35 profit, which on a dollar for dollar, if you take 15 times 2, that's 30. We're at more than a 2-to-1 risk reward. Or if you want to look at it a different way, it's about 200% gain on our money. Does that make sense?
Yes, yes.
So now if we come over and we look at the 67, well, right now we're at 72 1/4, right?
Yes.
Well, we could sit here and short the 67 for $66. Well, if we fall right back down to this 67 level, okay, we would be able to buy this back for about $52, but because it's so early and there's still premium, it'd be about $55. So if you think we're going to roll over, it might be a good quick bet to short at 66 and then have an order to cover at 60, if maybe 55, and make a quick $11. And your max loss will only be $34 if it just kept going up all day long. Okay. Another thing you could do is scale into these things. Okay. And what I mean by that is, so we just had a major fall right here, correct?
Yes.
If I come up here and I draw my Fibonacci's, okay, from high to low right now. Well, I know the 38 is at 75. The 50% is at 78.75. I could sit here and go, hey, I think, okay, we're oversold. We're bouncing, but I think I want to get short here, the 67, right?
Mm-hmm.
I could maybe say, hey, let me short the 67 one contract at $60. I'm risking $40. But if price does keep going higher and we don't roll over right now, then I could look to maybe add a second contract of this same 67 at maybe $67. That makes sense?
No, I didn't quite get that one.
Okay, so our first contract we would short at $60.
Yes.
Okay, and we'll short that right. I'll draw a line right here. Okay?
Okay.
It's 71, we'll say. That's our first short of a contract. If price continues to keep going higher, right now we're rolling over, but if it continued to keep going higher, and we're going up to a Fibonacci resistance level on the bounce of 75, I could look, I know if we get to 75, this contract would now be worth maybe $70 to short. Okay. Well, if it's worth 70, I'm only adding $30 more of risk, right? So I have one contract here. I have a second contract right here. Okay. And then if it kept going up to 78, 75, I can always short a third contract at, we'll say, $80. So my first trade, I have $40 of risk. My second contract, I have 30, and the third would be 20. So I'd have about a total of about $70 worth of risk.
Or 60.
Or 60, correct. Okay. But if I get filled here, I get filled here, and I get filled here, and then all of a sudden price comes and we reverse and we come all the way back down here, back down to the 67 target level. Well, the one I bought at 80, I could sell for about maybe $55. right? The one I sell at 70, 55, and the third I could sell at 55. I would make about 30, 40, maybe $60, $55 on the whole trade. Okay? Or I could just scale out. I could leave, like take profits on one. Think of it this way. It's just like trading stocks where we're dollar cost averaging. Do you understand what dollar cost averaging is?
Not maybe the way you understand it, but for me it's like for the dollar that you put in, you get like an average maybe 50 cents on it.
Well, think of it this way. If I buy something, if I buy stock, XYZ stock at $10, 100 shares, okay, that's my break-even point. If the stock goes down to $9, I'm down $100, right?
Yes.
Well, if I buy another $100 or another 100 shares at $9, okay, then I own 200 shares, 109 and 110. But if we go back up to $9.50, then I actually am break even because I've lost $50 on the stock I buy at 10, but I gain $50 on the stock that I buy at $9. But if we go all the way back up to $10, well, I break even on the $10, but I made $100 on the $9 stock. Okay? All we're doing, it's kind of like dollar cost averaging in a way, but also scaling to as we rise, hoping, going, okay, hey, we didn't get it, the market hasn't rolled over yet. Let me add. Now, not everybody agrees with the strategy. I'm not saying it's right or wrong, but if you understand how markets work, the ebb and flow of them, the ups and the downs, okay, then this could be a very profitable strategy. You're just, think of it this way on the bigger picture, okay? Think of it as, here is a zone that if price rallies up into, I'm going to look to start to get short. Okay? Meaning, I'm going to have my first position right here at 71. If it rallies, I'm going to add a second position at 75. And if it keeps going, I'm going to add at 79. Okay? Because none of us know where it's going to go, right? But as we rally, instead of going all in, 3 contracts right here at 71, hoping for the reversal, I'm just saying, hey, let me do 1 contract here, 1 here, 1 here, and trade within the zone to look to get short, because I have no clue how high the bounce is going to be. Okay? But let's now look at it now. Remember, the first trade we got short at 66, correct? When we were up here. Well, right now we're down to that 67 level, and we could buy this back for $56 now. So that would have been a $10 gain on the trade. And if you think about it, we were only risking $34, but we still have 5.5 hours to be correct on this trade. So the time helps us even out the odds a little bit. Like, we don't need to have stop losses. So in this scenario, we were looking to add at 3 different levels, potentially, correct?
Mm-hmm.
But one of the problems that happened right here was we only got filled on one contract. Well, guess what? We're okay with it because we're making money on the first contract.
So basically, when you're talking about taking those three contracts, so they're all gonna be working order.
Correct. So I would just put order at 70 to get short and one at 80. I'm not saying to do that. I'm just saying it's one strategy of trade. One type of trade that works really good with the binary side.
Yes.
So, the other side of it, and probably one other thing you could do too, is you could always just, and think of it as you're selling premium on options, right? So like right now, okay, we're at 68, 69 right now. I could just sell or like buy this, and that's kind of like selling premium, right? We're buying in the money, but if you think about our max loss is 61, but if we close above 67, we're going to make $39. It's the same thing as getting long, but if you don't think we're going to keep going lower, like right here we have a higher low, right? And it looks like we're now starting to potentially reverse. And if you go, hey, I actually think we're going to start to retrace and get all the way back up to this 83 level right here. Well, you could buy this 67 right here, but you're only going to make $39, but you could lose 61. But all you need to do is by 4:15 close above 67 to gain that full amount.
Yeah.
Okay? Or we could come over here and say, hey, I think we're getting back up to that 83 level.
Mm-hmm.
So maybe let's look at the 85. I could buy that for $16. Right?
Mm-hmm.
I could buy it for 16. Hey, if we get that big bounce, it's worth it, right? Because that thing, if we get up to the 83 level and we're looking at the 85, we might make, what would you say? Maybe $42?
Yeah, if it goes to all the way to 85.
Well, no. If we get to 82, we'll say.
82.
And that's our target, but this is at 85. The strike. How much do you think we could sell this for?
Probably for 52, 50.
Well, no. Remember, we're at 82 here. So, but the strike price is 85, so we're $3 below.
Below, okay.
Maybe 40 by 45.
Yeah, it's gonna be like that amount.
So what we bought for 16, we'd be able to sell for 40.
40.
But that's not bad. Still, that's not a bad trade, right?
No, because you got $24 profit.
Yeah, and you're risking 16, so you made 200% on your money. Okay. So, do you have any questions on any of this?
No, I really I understand the concept about the premium, and this one is basically because we don't know where the market is going. So you just open up some ticket, and then you make take some working order. But I understand the concept right now that it's good to buy low and then maximize. So basically, you're not gonna wait for the expiration. You're just gonna monitor the market, and then if there is a move, there is a way for you to exit. So basically, it's like you are scalping.
Correct. Correct. Now, if you want, you can leave it. Like if we start to rally, right?
Mm-hmm.
I mean, if you think the lows are in for the day, would I say buy this? Probably not. If you think the lows are in for the day, okay, I would say, look, maybe you buy one of these for that lottery ticket, right? Because if we rally all the way back up to the high of day, you can make $84 by the close, right?
Yes.
But if I was like, hey, I think the lows are in, I think we're going to rally for the next 3 hours or the next 2 hours, and maybe we get back up to the 80, I would I might just buy in at the money. I would maybe buy even this, the 67, okay, and maybe put an order in to try and get filled at like maybe 53. And then, so because if we rally all the way back to the high of day, I'm going to make $47. I'll make 1-to-1 on my money. But knowing that the lows are in for the day,
Mm-hmm.
I'm buying at the lower end, if that makes sense, right?
Yes.
And remember, it's all about managing risk. So if you get that big move, take your profits while you have them sometimes, because let me ask you this. Let's look at the 73 for a minute, okay? So let's say we buy the 73 for $38, okay? All we can lose is $38, but we can make 62, right? Well, let's say we rally all the way up to 80 to 90. Okay? And you're holding on to this. Well, if you could sell this for $90, okay? Would you sell it or would you hold on to it until expiration? Let's move time forward 3 hours. Okay, so you buy it for 38. We're now 90 by 93. Okay, so you could, what you bought for 38, you could sell for 90. Or would you sell it, or would you wait until the contract closes to make $10 more?
No, we sell it.
Why?
I will sell it because I'm gonna make money already on it, and I can still place another trade.
Correct. Well, you sell it because your whole risk reward changes, because now your risk reward is you can only make $10 more, but you could lose 90 now. You could give up all your profits plus your 38, because who knows what's going to happen in the last hour of trade.
Yeah.
What if we reverse and come all the way back down and we close at 29.70? So it's one of those risk rewards. Remember, always remember this, number one rule, right? Manage risk. Manage your capital. Number two rule is never forget number one, right? I mean, keep it simple. So knowing that we bought this, okay, at 38, if it's worth 90 or 85 or even 80, just take your profits, move on to the next trade, because if you manage profits, well, every time you take a profit, that's one less stop out you'll ever have. So
yes, that was my problem too, because sometimes I used to take trades and I will see I will profit maybe $30, but I'm still hoping to get the full amount, which might be $5 more. And then before I know it, it will drop, and then my profit gonna go from maybe $30 all the way to $10. Then I see I'm gonna lose everything. Then at that point, I take profit. So I think I should take profit while
when you have them.
yeah, when I have it.
Yeah. So think about this, right? Real quick, going back. Remember so price was here and we could have bought this contract at $38, right?
Yes.
So, and we'll just use this line right here. Okay. That's where we bought the 38. We're now at 26.50. Let's say we add a second contract at 26 down here. Okay? If price comes all the way back up here, and we have divergence, and this is the one reason I'm looking at this trade, we're making new lows, but we have divergence, right? So the way I look at this is price comes down, right? Well, our first buy was here. Well, if we buy here and price goes back to here, we'll break even on this trade, but we'll make maybe $10 on this trade. And that's another way of trading where you could close out and take profits here and here. They'd like break even here, win, but this one, because you added at 26, you'll now be able to sell that for 38 while it's up here or something around those levels. We would probably need price up here about 70, but you would maybe make $1 or $2 on the first contract, but you would make $12 on the second contract. And just another strategy of what you could do. So, and then one last thing for the binaries, let's look at this 55. Remember we were looking at that 55 earlier? And I forgot what the number was, but do you remember what we could have bought that for?
No, I didn't even write that.
Okay. It wasn't it $16? When we were up here.
Yeah, and then I would say if we go all the way to 83.
Or we'll say it was $30. I forgot the number, right? Sorry. It was 85. Remember when we were up here, I say, hey, this is where we could get that home run, right? Where we would sell that contract for $85, so we only had $15 of risk.
Yes.
Okay? Well, think about that. We were wrong for a while, right? But guess what? Now it's rolling over. Now it's in our favor. We're at 58. 59, we could buy this contract back right now for 65, 66, right? And we just made $19. Well, we're +1 to 1 risk reward. You might go, hey, I think, okay, this is far enough. There's divergence here. Maybe it's a Fibonacci level, whatever your case is, right? But you might go, hey, I'm happy with $20 because remember, everything just becomes scale after that.
Oh, yes.
Meaning, instead of doing one contract, you could do 2 or 3 contracts and then you made $60. Okay, but I just want to show that was a perfect trade. Where, okay, hey, we were wrong, and then all of a sudden we were correct on the trade, and now we could start to manage our profits.
Okay.
So, okay. Any more questions on the binary side?
No, it's way clear. I'm gonna rewatch again. The way I was trading with this Fibonacci was like I was using the 1 minute chart. Then I was trying to see, I was taking trades, the strike on the line. So for example, the white one, they are the open and the closing, so the high and the low. So if you break for example the low, I was expecting the price to go and hit the first resistance. So once he break, then I take a trade. I was doing the way you say in one of your video, first touch, you take a trade. So that's what I was doing, and then if it's in my favor, I stay in the trade. If it goes against me, then I will exit.
Gotcha. Now, here's one of the great parts, right? If instead of doing that, you could look for the bigger moves, correct? And if you actually get that bigger move, you're not risking as much. See, when you buy in the money, like, or even at the money, like right here, if I think we're going higher, we're at 59. So maybe I buy the 55. Well, now I'm risking $66 to only make 33. See, I don't like that type of trade. I'd rather look for the bigger moves and risk a lot less, that if I'm wrong, I'm not going to lose as much.
Yeah, that's what I like.
So, okay, awesome. So that'll be it for the binaries. Okay, I'm going to just stop the video, and then we'll make a part 2 for this, okay?
Okay.